Welcome to the short executive knowledge lecture on topic 5, paper 7 of the SFC licensing exams. This topic covers the foreign exchange and derivatives markets, and we'll be looking at just that, the foreign exchange market and certain aspects of it, the derivatives market generally, and then the derivatives market in Hong Kong. I will emphasize the important points to help you understand the core material you need to know to sit the exam, and a copy of the study notes that you can see on the screen can be downloaded from the Executive Knowledge website under Paper 7 Resources. As ever, I strongly recommend that you supplement this learning with question practice, and we have over 300 practice questions uploaded on the Examinator.online platform. Okay, let's start with the foreign exchange market. And some of the material, highly examinable, some of the material, background, and I will make the distinction as I go through. Section 1.1, note we see a lot of this coming up in questions, so let's go through the background definitions. Foreign exchange market, the world's largest global financial market. As we'll see, it's an over-the-counter market. It's also referred to as Forex or FX market. As I said, it's an over-the-counter market. It's traded 24 hours a day, and there is no headquarters. There's no specific geographic location. The trades covering currencies at current exchange rates, they are known as being in the spot market. So the spot market involves spot rates, current exchange rates. Whereas currencies traded for delivery at a future date and an agreed rate are known as the forward market. Now the forward market, very important for this exam. There's likely to be at least one question on a calculation of the forward exchange rate, and we covered that at the end of section 1. Participants in the foreign exchange market quoting prices for currencies, they're known as dealers or traders. Majority of currencies in the FX market are quoted against the US dollar. That is the standard format. However, where a pair of currencies, not including the US dollar, are quoted against each other, that is known as a cross rate. Please be aware of that. That can be examined. Now, if the US Hong Kong dollar rate is quoted as $7.80, this means $1 US is equal to $7.80. Now, this format can be confusing. US dollar : Hong Kong dollar. What that means is Hong Kong dollars on the numerator and the US dollar 1 on the denominator, and that will be relevant for material later on. Section 1.2 covers the history of exchange rates. If you're a history buff, this might be interesting. It's unlikely they're going to go into details of First World War, etc., but I have seen the Bretton Woods Agreement pop up in a question. Third last bullet point on page 2 there. Bretton Woods Agreement was made in 1944 as the Second World War was approaching its end. The agreement involved 44 countries and established a global financial system that was designed to operate after the war. And under that agreement, the US dollar was fixed at $35 per ounce of gold, and other countries established par value against the US dollars. Rates against the US dollar were maintained by buying and selling home currencies. Now, the Bretton Woods Agreement operated until 1973, when under the weight of Vietnam War, US budget deficits, it was replaced by a system of floating exchange rates, which operates to this day. Now, different exchange rate regimes, I'd be aware of the differences. We have floating rates, fixed rates, and linked rates. Floating rate, that is where the currency's value is determined by the market. That is market, supply, and demand, and that can come up in the exam. Fixed rate system, that's where a government or monetary authority sets fixed rate of exchange with another currency, and it will intervene in the markets to ensure that that fixed rate is maintained. Now, a linked rate, This is a type of fixed rate regime where local currency is linked or pegged to a particular foreign currency, usually a trading range around the target rate, which is monitored by the government and the Monetary Authority. And as we'll see, the Hong Kong dollar has a linked exchange rate with the US dollar, but we also operate as a currency board system, and we'll talk about that in a moment. The Hong Kong dollar rate, well, this really is background. I've never seen this examined, all the different rates over the years until it's settled. The last bullet point there, it tells us in October 1983, current system was put in place whereby the Hong Kong Monetary Authority undertakes to buy US dollars $7.75 and sell US dollars $7.85. So the rough link is 7.8. Now, the Hong Kong Currency Board system that I just referred to, this is where note issuing banks deposit the equivalent amount of US dollars for the Hong Kong dollars with the Hong Kong Monetary Authority for issuing the Hong Kong dollar notes. And the money goes into the exchange fund, which is maintained by the Hong Kong Monetary Authority. So the Hong Kong monetary base is fully backed by US dollars. That is, it's a currency board system that operates a linked exchange rate. Exchange rate mechanism, European monetary system, and the euro, again, that's very much history. Read through the points, but highly unlikely to come up in the exam. Now, the foreign exchange market, as I said earlier, no specific geographic location, no formal hours, and it's considered to be a perfect market. Why? Because it has a large number of active buyers and sellers. Transaction may relate to trade settlements or speculations where the speculators are looking to profit from exchange rate movements. We also have trades that are entered into as a hedge to hedge particular participant positions. Now, market participants can be viewed as either speculators or hedgers and include the following. So, retail market, corporations, fund managers, financial institutions, brokers, and central banks all are active in the foreign currency markets. Okay, now we come to a very important point. Now, this is very technical, as you can see, section 1.5, calculating currency forward exchange rates. And there's going to be at least one question on the exam where you have to perform a calculation, either calculating a forward rate or the spot, or making some commentary on it. So as we say at the top, currency forwards are agreements to buy or sell a quantity of currency for delivery at some time in the future at an exchange rate fixed at the time of the agreement. Often you enter into a forward exchange rate with a bank, and you agree with the bank that in, let's say, 1 month's time, you will pay a particular exchange rate or receive a particular exchange rate for a transfer of funds. So if we're looking at an exchange rate now today for settlement in 3 months' time, then we are wanting to hedge. We're wanting to lock in to a particular exchange rate, and that locking in mechanism will relate to a forward rate. And the forward exchange rate of a currency is equal to, and here's the very important formula, you need to know this, and when you go into the exam, you write it down immediately. Forward rate's equal to the spot rate multiplied by 1 plus the interest rate of the numerator country divided by 1 plus the interest rate of the denominator country. Now, what am I talking about? When we look at an exchange rate, you will have a numerator and a denominator. For example, the Hong Kong dollar to the US dollar, the numerator will be 7.8 Hong Kong dollars. So the Hong Kong dollars on the numerator, and the denominator 1 US dollar, the denominator is US dollar. And that's what I'm referring to as the interest rate of the numerator country and the interest rate of the denominator country. Let's look at an example and see how this operates. Currency forward exchange rate example. Calculate the forward exchange rate with the following information. So the British pound US dollar spot rate is 1.35. That is, you have 1.35 US dollars for a British pound. UK interest rate is 3%, US interest rate is 0.75%. So if the US dollar is on the numerator, then the interest rate of the numerator country is 0.75%, and the interest rate of the denominator country, the British pound on the denominator, is 3%. Now what we need to do is plug the numbers into the formula. So the forward rate is equal to the spot rate, 1.35, multiplied by 1 plus the interest rate of the numerator country, that is the US, 0.75%, which in decimal form is 0.0075. And we divide that by 1 plus the UK interest rate, which 3% in decimal form, 0.03. Perform the calculation and we find that the forward rate is 1.32. Now, it's very important that you're comfortable with that formula and you can perform the calculation for the exam. Okay, let's look at the derivatives market. What are derivatives? Financial instruments that derive their value from an underlying asset or financial instrument. And we've got two types: commodity derivatives, and they derive their value from a commodity such as oil or gold, or financial derivatives, and they derive their value from financial instruments such as stocks, bonds, interest rates, and currencies. Now, derivative markets are predominantly focused on financial derivatives, although commodity derivatives are out there. Hong Kong is principally a financial derivatives market. Now, functions of derivatives, 4 functions. Risk management, that is, a price can be fixed now, that's hedging, protecting against future adverse price movements. Reduction in borrowing costs, so interest rate derivatives are used to reduce borrowing costs, especially interest rate swaps that we will look at a little later. Increased flexibility, that is, dealers and traders able to choose between trading derivatives or the underlying assets. Now, trading derivatives is often much cheaper, but there's an element of leverage, providing trading strategy flexibility. And arbitrage, you can buy one instrument, sell the other, lock into a risk-free profit, thereby keeping markets accurately priced. Now, as we said there, derivatives are a zero-sum game. One party will gain, the other party will lose. Okay, let's look at different classifications of derivatives, starting with section 2.3.1, exchange traded versus over-the-counter derivatives. Now, exchange traded derivatives are traded on organized exchanges. There are 2 types in financial derivatives: options and futures. We're told the oldest commodity exchange in the US, Chicago Board of Trade, unlikely that's going to come up in your exam, and that trades agriculture commodity futures. Now, that's a background to where the futures market came from. Commodity futures came a long time before financial derivative futures. Most common exchange traded derivative is the future. And please be aware that futures are only traded on exchanges. You cannot trade futures over the counter, whereas options can be traded on an exchange and over the counter. Example of exchange traded derivatives: index futures and options, warrants, which is a form of option, stock futures and options, treasury bill futures and options, treasury bond futures and options. And right at the bottom, we recognize that, as with any exchange trade transaction, the clearinghouse will guarantee their trade. So counterparty risk is eliminated, as the exchange will act as counterpart to both buyer and seller. That's known as novation, and it's the clearinghouse that guarantees settlement. Moving along, more on over-the-counter derivatives, and these dominate derivatives market, much higher volumes than the exchange-traded market. Unlike standardized exchange-traded, the over-the-counter derivatives, they are tailor-made, customized for the requirements of the counterparty. You will negotiate, you will enter into a position. And we just summarize the difference between exchange-traded derivatives and OTC. The exchange-traded, as you can see, standardized features. They are, as I've just said, traded on exchanges. The exchange acts as counterparty, and there's no credit risk. Whereas with over-the-counter derivatives, tailor-made features, set up not in an exchange, but by phone, by email, direct contact between buyer and seller, and there is credit or counterparty risk. That is, there's a risk that the counterparty defaults, does not settle. 2.3.2 looks at futures. Agreement to buy or sell an underlying asset at specified price. It's a standardized forward contract. They are exchange traded. You pay an initial margin, a good faith deposit, when you enter into a futures position. And there's daily market to market with the possibility of margin calls. A margin call would be activated if you go below the maintenance margin level. And futures are usually closed out with an equal and opposite transaction. So if you've bought a future, you'll close out by selling. Forward contracts, these are not traded on an exchange. These are over the counter. There's no margin, no collateral requirement, but there is counterparty risk, as we've said. And the two parties will agree to buy and sell an asset at an agreed price at an agreed time in the future. Now, one particular type of forward is a forward rate agreement. This is to do with interest rates. Forward contracts between two parties lock them in to an agreed fixed interest rate over a stated period of time. And it's locked into a fixed interest rate. Now, we've got some practice questions on Examinator.online that address forward rate agreement issues.